Welcome back, everybody, to the complete beginners course for ICT students. This video, we're going to cover premium and discount, dealing ranges, and how to determine them. So, introduction to premium and discount. What is premium and discount? In the context of ICT's teachings, premium and discount refer to price action in the market. A premium market is when the current trading range is at a higher level, while a discount market is when the current trading range is at a lower level. The market tends to move between premium and discount levels, seeking liquidity and adjusting valuations. The idea is to buy at a discount and aim for premium objectives, or sell at a premium and buy back at a discount. This movement between premium and discount levels is driven by factors such as institutional order flow, central bank actions, and market sentiment. So the market will move between a premium and a discount. The easiest analogy or the best way to look at it is either you want to be buying a product at a discount, right? If you go to a store, you want to be buying something on clearance. You want to be buying your soap, clothes, laundry, whatever it is, you want to be buying it at a discount. And if you're selling something, you want to be selling that at a premium price. If you're, selling a car, your clothes, whatever it is, you want to be selling that while the market is at a high, right? So that is the way the market is moving. It's moving between a premium and a discount constantly. What is a dealing range? This refers to a specific range or zone that price will trade from either discount or premium. Dealing range will be defined by a high and a low of the most recent swing of price action. So throughout the last videos and previous videos, you've already seen what a dealing range looks like, and I'll refer back to it more in this video specifically. But basically, it's between your previous highs and lows. How do I find these ranges? Each time frame will have a different dealing range. The easiest way to identify these is marking out market structure and identifying whether you are in an uptrend or in a downtrend. So like I said before, I've already mentioned these, but I'm going to do a more in-depth view of it. Example, in an uptrend, you will mark out the previous higher low to the most recent higher high. This will be your dealing range, where you will identify your premium and discount levels. How would I be able to determine these myself? So from a naked eye, you'll be able to see this, but we have a tool, especially in TradingView, that you will be able to utilize to see these dealing ranges a little bit more easily and see premium and discount levels. So as an analyst, we use a tool called Fibonacci. This tool easily allows us to determine premium and discount levels. As described before, we want to be buying inside of a discount. Vice versa, we want to be selling inside of a premium. How do I utilize the Fibonacci tool? If price is in an uptrend, you draw the Fibonacci tool from the current low in an uptrend to the highest high. We would then mark out our discount range, which would be anything beneath 50%, which is equilibrium. If the uptrend is to continue, then price should retrace into the discount before continuing higher and above the highest high. So next slide, I will have a example of this, or at least should be the next one. What is the optimal trade entry? So this is a little bit more advanced, but I wanted to put this in here so you guys know what this is as you advance into these concepts. Optimal trade entry, otherwise known as OTE, is a trading concept that focuses on identifying the best entry points in the market based on specific patterns and conditions. ICT references how OTE is the best place to be buying/selling inside of premiums or discounts. OTE is often associated with retracement levels such as the 62% and 71% levels, which help to highlight short-term oversold/overbought conditions relative to a specific dealing range. The dealing range is defined by a low and a high point, and the Fibonacci retracement tool is used as a visual representation of these conditions. In easier terms, it is the best place to short/long inside of a premium discount. Okay, so this is how you determine a dealing range, and this is how I'll show you with the next couple slides how to put your Fibonacci tool on there and what that all means, because I know that a lot of that text may be confusing for the visual learners. So in here on the left side, we have an uptrend. We have higher highs and higher lows being printed. So a dealing range is anywhere between, if you're in an uptrend, you're going to be looking at this previous higher low up to the higher high. So this is your dealing range. This would be also your dealing range. So from this higher low to that higher high, wherever the higher high stops, that's your dealing range high, and this would be your dealing range low. So from this dealing range low to this dealing range high, you have in the middle of that would be equilibrium. So that's 50%. In an uptrend, anything beneath equilibrium is a discount. So remember, if I want to be buying, I want to be buying in a discount. I want to be buying something that's on clearance, right? So as the market breathes out and it's breathing back in on that retracement, breathing inside of that dealing range, I'm marking out from that higher low to that higher high, I'm seeing where the discount is. So as it comes back into the discount, I want to be buying inside of this discount. And then we're expanding out to attack what? Buy side liquidity here. So inside of the selling, you can see I want to mention here the premium. We don't want to be buying inside of a premium, right? We want to be buying inside of a discount. So anything inside of that red shaded area, we don't want to be buying inside of it. So that's how we look for the best place to be buying in an uptrend. So on the selling example, you have a downtrend, lower low, lower high, lower low, and then on a lower high, this is a premium. So this is equilibrium. So from this lower high to this lower low, that's your dealing range. So price breathes out. When it breathes back in, where are we looking to sell? I don't want to be selling in a discount, right? Because discount, that's not a good place to be selling. I want to be selling in a premium. So anything above equilibrium, which is 50% of this dealing range, I want to be selling in that premium. And that's where the lower high is. So price breathes in and then it breathes out. So it's breathing out inside of the premium. And that's the best place to be selling. And that's the best place to be buying. So here's a real chart example of buying in a discount. So you can see this is our higher low, a swing low to a swing high. So price breathes out. And what I'm doing is I'm marking out the dealing range low to high. This is equilibrium here. So look, what are we doing? We're not buying in a premium, we're buying in a discount. So inside of this blue shaded area, this is the only place that I'd be looking to be going long or buying the market. So when price breathes back in and retraces, I'm looking to buy inside of this discount. Now, what did we learn from the previous slide? What are fair value gaps? Look to the left of you. Do you see a fair value gap in here? I do. So if you're inside of a discount, you want to be looking for fair value gaps inside of that discount. So you have an extra confirmation and confluence to go long in this market. And what are we doing? We're targeting buy side liquidity. Do you see how there's a common theme of constantly going into a discount, targeting buy side liquidity? In here, this is a downtrend. We have a lower high up here. So this is our dealing range high. Price breathes out, makes the low. So from this high to this low, that's our dealing range. Price breathes back in into what? A premium. Look to the left of you. That would be a fair value gap in here. So that's in confluence with the premium. So we want to be selling inside of this premium. And as price trades off, and what are we doing? Attacking sell side liquidity underneath this low here. So do you see how it's all starting to come together? And as we go on to the later portions of the video or the series, you're going to see how it all fits together perfectly. So what does a Fibonacci tool look like? If you go into TradingView, and there's some good videos on YouTube, I'm sure you can look it up. But there's going to be a tool that you can use, and it's called Fib Retracement. And basically what this will do is it allows you to see premium and discount levels a little bit better. So much like the previous example, you can see this is our higher low to our higher high. So this is our dealing range. So on the Fibonacci tool, you're going to have a bunch of different levels. So this is 1, this is equilibrium, 0.5, and then 0. So you want to take, when you use the tool, you take 1 to 0 to mark out your dealing range. And what these are these are negative extensions. So this is telling you where price could potentially go into. So with the Fibonacci tool, it's a really good use to see, okay, if price reaches down into our discount and it breathes out again to expand, then where should price likely go to? And you can see here, these Fibonacci levels are going to tell you where price could lead into. So negative 0.25. So negative 0.25, that is of this entire range. So 0.5, that's half of this entire dealing range. And if you did -1, that would be the expansion or extension of this entire dealing range. So hopefully that makes sense. Again, price reaches down into a discount. We want to be buying inside of here. That's underneath what? Equilibrium. And price expands higher to attack buy side here and expand into there. In a downtrend example, same thing, dealing range high to dealing range low. Price reaches up into a premium above equilibrium, and then price extends, breathes out, attacks sell side, and extends into, you can see negative 0.5 and then -1 down here. So you could use those as take profits, places that you could look for price to extend into. So back to, I believe, slide number 4, introduction to optimal trade entry. So now you know what premium and discount levels are and kind of what a Fibonacci tool looks like. Inside of the Fibonacci tool, you can change the certain values and the levels inside of it. So really what optimal trade entry is, it's a great place to look inside of premium or discounts to be buying or selling. So if we're in an uptrend, our dealing range low to high here, we mark out our Fibonacci tool, price retraces into a discount, right? If I'm looking for buys, I'm looking to go long, then I'd be looking inside of the discount area, which is anything underneath the 50%. So 62 and 71, those are optimal trade entry levels given by ICT himself. Each of these green shaded levels are really good areas you can look for price to reach down into for then price to expand away from. So if you're in an uptrend, you see price reaching down into a discount, look for those optimal trade entry levels and then see if there's a fair value gap inside of that optimal trade entry level. That's a really good confluence, right? You're adding a lot of things to the recipe to make a good trade idea. Vice versa, you're in a downtrend, so that's our dealing range high to our dealing range low. Price breathes in on the retracement, gets above equilibrium into a premium, into optimal trade entry here, and that would be a really good place to look to go short. And then price breathes out, attacks sell side underneath here, and extends to either 0.25 or 0.5. Again, those are good places to look for your take profit zone. So this is a real chart example of optimal trade entry in here. So you can see dealing range low is down here to dealing range high. So we're in an uptrend, price is going up. So anything above equilibrium in here, what are we doing? We don't want to be buying, right? Because that's in a premium. But anything beneath the 50%, we want to be looking to buy. So price reaches down into the discount and into what? Optimal trade entry. Look to the left of you. What do you see? I see a fair value gap in here. So off of the two things that were already taught, the fair value gap and the discount, those are really good areas, plus the optimal trade entry. So price digs down into that and then breathes out again to expand towards the buy side liquidity here. Vice versa, you're in a downtrend, you're looking to sell. This is our dealing range high, because that's the highest high, down to the dealing range low, which is the lowest low. Price breathes in, goes above equilibrium. This is the premium. Everything above equilibrium is a premium. Anything beneath that is a discount in a downtrend. Price reaches up into a premium, into the optimal trade entry levels. It doesn't have to hit 62 and 71 perfectly, but those are areas, like I mentioned before, you could look for price to reach up into. Fair value gap here, and then price sells off, breathes out to attack what? Sell side liquidity underneath the low there. So in a whole, that is how you're able to determine dealing ranges. premium and discount levels, how to use your Fibonacci tool, how to, utilize optimal trade entry. All these can be found on ICT's YouTube channel, as I've described before. This is just a quick, brief overview of all these concepts and how to put everything together. So hopefully you guys have been enjoying. Let's get into the next video here.